Let's get 3 minutes on the clock to talk about your market minute. How is that fear factor over geopolitical tensions playing out this morning?
Well, you can see it very clearly across assets. Commodities, energy commodities in particular, are bid. And remember that Russia is not just a major exporter of energies, it's also things like agricultural commodities. Both Ukraine and Russia are big wheat exporters, for example. So we're seeing that bid in commodity prices. We're seeing Russian stocks a little bit weaker. And generally there is this risk aversion, this nervousness across markets. Now, it's important to be very clear that the risk aversion across markets can't be attributed just to what's happening in Russia-Ukraine. That is not helping the mood. But of course, it's all about the tighter liquidity due to higher yields. And again, as I mentioned, on Friday, we saw that real rollover in the US consumer. And that is a very bad sign for global stocks as well.
Okay, so if part of it is about tighter liquidity conditions, what do we make of what Treasuries do? Because they clearly had a bid on Friday because of that desire to own more havens. How do these two forces play out against each other?
They do have a bid, and you're seeing some of the auctions. You're seeing that foreign central banks still want to kind of lap up these high yields they can now get in treasuries compared to a couple of months ago. But again, that's the point. It's where we've come from so quickly. We're talking about two-year yields on a 1.5% handle. You know, it was only about 6 months ago that it seemed impossible that they'd move off a 0.2% handle. So we've really just gone an extraordinary way very, very quickly. The environment is changing very rapidly. And you see that in the price action this morning. Even though Fed officials attempted to push back and we saw a little bit of a bid for treasuries, we saw those front-end yields come a little bit lower on Friday. They're again nudging higher again this morning. And the overall kind of story in yields in the US is that for every kind of 4 steps higher, yes, we do take 1 or 2 steps lower again, but the trend is very clear. These yields are higher consistently over the last couple of months, and they still have much higher to go.
Mark, I know you were also, this is a little bit out of left field, I will admit, but I know you're also looking at the stories of the global protests and perhaps becoming a relevant theme for markets?
Yeah, I think so, very much so. I mean, this was the real one that kind of seemed to gain traction is what's happening in Canada, obviously blocking off one of the key motorways there. But I think the fact that it's spread to New Zealand, Australia, France, we're seeing it in many different continents now. And this is becoming an issue. It's both a supply chain problem, and again, it's about this kind of businesses being blocked when they're just trying to come out of the recovery. They're just trying to get a new kind of tailwind. This is a really, really bad time for these protests to come. And I think the backdrop is still there for them because people are kind of tired of the COVID situation. Consumers are getting squeezed via inflation. Real incomes are getting cut. So the reasons for these protests are another real negative fundamentally themselves. So I think that, yes, this is something that's kind of at the margin, growing as a negative for stocks. The backdrop's not great out there at the moment.
It's not. That's 3 minutes up on the clock. And I just do want to add, we are seeing that filter through earnings, right? There are concerns about margin. We heard it from Unilever, for example, last week. Mark, as always, thanks so much. And remember, you can stay up to date with analysis from Mark and the team. Just MLIV GO on your terminal.